It's become a bit of an infamous term these days, margin call, partly because of the movie that was called Margin Call, which is a great movie by the way, and partly because of communities like Wall Street Bets that became very famous in the last few years, where having a margin call is almost like a badge of honor. But actually the term margin call has been around for a long time, and as a trader, it's not really something that you want to be experiencing. So, what are margin calls and how can you avoid them? It's quite common to use leverage and margin accounts, particularly when it comes to trading Forex, because the trade sizes can be quite big. So for example, if you wanted to open a one lot trade on Euro US dollar, without leverage, you'd need 100,000 euros. Now, most retail traders just don't have that kind of money up front to open a trade. But if you have access to leverage, like for example 100 to 1 leverage, that means you'd only need 1,000 euros in your account to open the one lot trade. Now that 1,000 euros would be known as the margin, and it's the minimum amount of money that you need to keep in your trading account to keep that trade open. So as long as that trade is open, you can't withdraw that margin amount. But then what happens if that trade starts to lose and the account value comes close to that margin amount? Well, this is where you're going to get a margin call. It's basically a warning from your broker that either you're getting close to or you're exceeding that margin amount for keeping the trade open. So using that same example again, let's say that we want to open a one lot trade on Euro US dollar and we need 1,000 euros in margin. Now if you have just 1,500 euros in the account, that does mean that you can have the trade open, that's the 1,000 euros margin, and there's a bit extra so the price can enter a loss without hitting a margin call, 500 euros of loss. But if the trade goes into a loss of beyond 500 euros, like 550 euros, you'll be within the margin requirement to keep the trade open, and this is going to result in a margin call. Now at this point, you have three options. The first option is to increase your equity in the account by depositing more money. And this is what your broker is obviously going to suggest to you because that's going to favor their business. So they're going to email you or call you and say, deposit more money to keep your trade open. Now, there are situations where that could be viable, but in most cases, you're hitting a margin call because you haven't managed your risk properly. And especially as a beginner, if you deposit more money, you're just throwing good money after bad and you're going to most likely end up with a much bigger loss. So it's better to take one of the next two options. The second option is to just reduce the position size to close part of the position. That means that the margin requirement on the remaining part of the trade is much lower. You might have a bit more of a buffer that you're not into that margin amount, but obviously you're accepting a loss on part of the trade. But that might be favorable in some situations compared to the third option, which is to close the trade completely. To accept the loss, that's going to eat into your balance, and whatever's left, that's now yours. You can withdraw it, you can trade with it, whatever you want. Now, that third option may actually be taken out of your hands by your broker, depending on how big the loss is and how much it eats into the margin. With different brokers, it'll be different amounts, so you need to check with your broker before you're opening trades, or just not do anything that's going to lead to a margin call in the first place. But with some brokers, it will be 50%, some 90%, 70%. And when it exceeds that, just automatically they'll close the trades. So it might be the case that you actually get the email with the margin call or get a phone call. And by the time you actually get to the charts to sort things out, the trade's already been closed and you're left with a much smaller account balance because they've taken the loss. But it's better to not be in that situation in the first place. If you're hitting a margin call, it means that you're most likely risking too much for your account on each trade. So you can take actions to reduce the risk of margin calls by making sure that your risk limits, your position sizes, are reasonable. And at Duomo, we typically recommend a maximum of 2% at risk on any single trade. Because beyond that, it's going to lead to negative trading psychology issues, it's going to increase the probability of burning out the account, and you never want to run the risk of ruin. So it's much better to have a sensible amount of risk, and then you never have to worry about a margin call. So that basically sums up margin calls. It's a warning from your broker that you need to either deposit more money to keep the trade open or have the trade closed, and you should be able to avoid it by managing your risk in an appropriate way. And then the only time that you need to hear margin call is if you're sitting down with some popcorn to watch the film, which is a much better option. So thanks for watching. If you want more free resources, check the description box, leave a thumbs up. I'll see you soon.